I actually got hooked when I asked it to code an option pricer in Python. And it did it in 2 minutes and gave me a working code.
So welcome to our very first episode of Navigating the Finance World. I'm your host Kunal, and today we have our esteemed MBA professor, Professor Prateek Sharma as our guest. Professor Sharma has pursued his master's from IIM Lucknow, and after spending a short period in corporate at Citi, Professor completed his doctorate from IIM Lucknow and delved into academia. A very warm welcome, Professor, and thank you for joining us today.
Thanks, Kunal. It's a pleasure being here.
So, without further ado, let's start. So, can you share your journey leading into academia and research in the field of finance?
So my journey was not very straightforward. I didn't set out to begin in academia. So I did my engineering in computer science, and I first started as a software developer. So in my time, there were 3 big companies, Infosys, TCS, and Wipro. So I applied there, I got through in all of those places, and I joined Infosys because they had free bowling fingers. So I thoroughly enjoyed my time there. So I enjoyed programming, and that actually got me started into many different areas. One of my client at Infosys was British Petroleum. So we were working at a project which was trying to replace the POS machine that you have for card swiping. So that got me my first taste of finance. So I got to understand how Visa and MasterCard work, for example. They have a gateway, you swipe your card, then there's some information on your magnetic strip that goes there, they authorize it, they settle the transaction. If something bad happens, they have to reverse that. So I had some understanding of the mechanics of finance there. Found it quite interesting. Later on, after spending a year or so there, I got a bit bored and I thought that Infosys is not very dynamic. It's a large organization. Let me go to a place which is dynamic. At that time, I was young and naive, so I was like, you should not stereotype people. I was stereotyping companies. So I thought Infosys is a large company, so it must be boring and organized, and you don't have opportunity to grow there. So let me go to a startup, young company which does not have too many employees. So I did that. I went to a startup which was a financial consulting. I had a developer role there. So I worked at a company called Indus Valley Partners. So there I really got to learn the ropes of hardcore finance. I got exposed to derivatives. We're actually making an OTC exchange for a company called QuadriServe. So they used to give all sort of derivative solutions to their clients, which were traded on that exchange.
I mean, the strategies basically.
So they had different solutions which were traded. QuadriServe was the exchange, and there were people who were willing to take both sides of it. So they were essentially OTCs over the counter. So what you do is you are a bank, you talk to another bank and you get into a transaction, right? But it's not always very easy to find another bank who wants to take a counter position. Yeah. So this was an exchange which was going to facilitate common forms of transactions. Right, so that's what it was working on. Then I did my MBA, majored in finance, and I worked in Citibank for a year. Now, Citibank, my role was not into markets, which was my core interest, but more into commercial banking and strategy, how to increase the number of salary accounts at Citi, for example. So that was fine, but not something that really interested me. By that time, I developed a lot of interest in financial markets. So I thought I'll do further studies. So I did my PhD from IIM Lucknow.
It seems like you have some fascination with your
I have some affinity to IIM Lucknow, and also because I'd been there as an MBA student.
Yes.
So I knew good professors there. Oh. So in PhD, rather than the institute, what is more important is the person you affiliate with.
Yes.
So if you, let's say, want to do research in operations, and there's a great operation researcher in IITs, right? So you would want to do it in IITs instead of an IIM. Right, so that was my intention. I had a fantastic professor there, Professor Vipul, under whom I did my PhD. At the time, he was the finest researcher in finance in India. Now he's retired, and we have grown as a research community. But at the time when I was doing my PhD, his papers, his publications were among the finest in India. So I got to learn a lot from him, and I further developed some new insight through my research also. So that was my journey into academia. After my PhD, I joined various academic institutes, and I ultimately ended up at IIM Udaipur, where I found that the support for research and the independence that it gives to its faculty is almost unparalleled. Even I think I can say it for even for IIM ABC. The kind of research support that you get at IIM Udaipur as a young faculty, I don't think even those premier institutes would match it. So I really enjoyed my initial stint. I could refine my very basic ideas about some research themes. So happy to be here. This is my 5th year. By the time I was 30, I'd left 6 jobs. And this is the only job where I've stuck for 5 years. Wow. I'm really happy here. So that's about my journey to academy.
I think so. Environment is also an additional factor to Udaipur, no? The kind of view you get and fresh air.
Right, so I worked in Himachal for a while. View was better, but the place is definitely better.
And that's fascinating. So let's move on to something else. So considering the financial awareness and personal finance in India, what are your views on it? I mean, how do you think one can effectively manage their finances?
First of all, it's important and it's overlooked. So many people who are otherwise quite savvy in their own disciplines would actually be either negligent in managing their finances or maybe think it's too complex, right? So there are two sorts of problems I've seen. There are some people who get too engrossed in it and they would want to try to understand every particular minutiae. Now for me, it's easy because it's my day job, right? I have to study finance. Think of a dentist or someone who works in army. It's not their day job.
No.
I think that's a wrong approach. So what these people will do is they will learn some introduction to investing, maybe through a YouTube video or Coursera course, then they'll read a book, and then they'll start learning about money masters like Lynch and Buffett. Then they'll graduate to financial statement analysis, then they'll read Intelligent Investor, and then they'll exhaust themselves because they don't have the bandwidth to do all this. And the utility of doing this is not that much for a, let's say, for a personal finance decision. I think for personal finance, it is important to keep things simple, follow some common sense rule of thumbs that have stood the test of time, and use those strategies. I mean, you don't have to have any fancy asset allocation. You don't have to follow any fancy trading strategy, technical indicators. You can follow some very, very common sense rules and have discipline to track them, course correct if you deviate from them, and you would be in good stead when, let's say, you retire. So let me talk a bit more about what these strategies are. So this would sound very trivial, but it is important because so one problem is you exhaust yourself when you go into minutiae. The second problem is you accentuate your confidence, which may be misplaced. So
and bias.
Yes, so that's a kind of a bias. Right? So it's not just for lay people. I know finance PhDs who, when they keep reading about a particular theme, they start to increase in their confidence. They start to overestimate their ability to predict. Right now, if you open television, you will see these candidates. Right, so you will see economists, you will see market experts who will very confidently predict what is going to happen to a particular sector, what is going to happen to a particular theme. I still remember during COVID, as pharma stocks were booming, so every expert who turned up on the TV said that it's a multi-year structural story in pharma. Right now, it didn't turn out that way. But if you looked at TV that time, you will if you already hold this bias, you will confirm that bias because every single person who you hold in some regard is saying the same thing, right?
Exactly.
So the more you start learning about these things, so if there's like an echo chamber, right? So I have a prior. Now I hear many smart people talking about that prior repeatedly. The more I hear about it, the fundamentals have not changed. It may be that there is some probability of this thing happening. It's a pharma being in a structured bull run. Now, the more I hear it in news, the more confident I get. But the fundamentals don't change, right? So if I hear news 20 hours a day, I feel more and more confident, right? So that starts, then I have this divergence. I become more confident in the structural story, whereas the fundamentals of the structural stories are what they were earlier, right? It doesn't depend on how much I am watching CNBC, right? So I will be overconfident, and the way that it materializes is I will increase my bet size. I will increase my risk taking. So that is actually harmful, right? So more information is not necessarily good, especially for personal finance decisions. So what is these rule of thumbs? First is have a budget, right? So let's say you are having a monthly salary. A good rule of thumb is at least 20% of that should go towards saving.
Sure.
So, or I would say if you can manage it, at least a third, right? Now have a budget for your expenditure. Track it. It's easy to track it now. You can get, everything is online, so you can get your monthly statements and you can track it. Track your spending habits and expenditure. So you have a spending budget and you have an investment budget. So that's your that's the biggest decision that you make. So if your 30% is your investment budget, your life is not going to be linear, right? So every single month, you may not be able to save 30%, but when you track it, you will be able to recognize that there is a deviance, right? So I wanted to save 30, but for the last 3 months, I could not do it. So as soon as possible, course correct. And that's only possible if you do this tracking, right? The second thing is, as much as possible, because by very nature, we are not disciplined creatures, as much as possible, automate your investments. So for example, you can have standing instructions or have SIPs, right? Now SIPs have other advantages also, but one overlooked advantage is you don't have to think about it, right? So you get your salary at first, at third, maybe you have 5 SIPs and you invest in 5 different asset classes and it is automatic, right? Yes. So you don't really have to put your mind to it. You cannot forget it. You will not deviate from it, right? And you have to consciously stop it, right? So when you consciously stop it, you know that you have done it and you will course correct. That's some basic discipline that you can have. So having a budget. Then second thing is, people say that this is the biggest decision that you make. That's asset allocation. I think a better way to put it is diversification. So even within an asset class, you want to be diversified, right? So you want to be diversified across asset classes. So asset classes are basically broad categories of assets which behave in a similar way, right? So for example, all stocks, you can have stocks from different sectors, but more or less they behave in a similar way. Especially you can see this play out when there is a sharp move in markets. Right? So during COVID, everything fell down. Right? So stocks are an asset class. Then the second asset class that we can invest in is bonds, right? So bonds are also called fixed income instruments. So fixed income instruments basically are much like your FD. So if you are not familiar with bonds, you can think of it as an FD. It promises you a fixed amount of return, right? Against that, you have to lock in your money for some time, right? So that's bonds. You can also have something called cash. Now, cash is not cash that you have in your pocket, but you should store your cash in liquid funds. Yes. Now, liquid funds are vehicles which, as the name suggests, are very liquid. You can get your money out very quickly. So these will be investing in money market instruments, which are treasury bills, commercial papers. Essentially, you don't have to worry about it if you don't understand it. Basically, it's like a savings account that gives you a somewhat more interest, right? So it's liquid as a savings account and gives you somewhat more interest, right? So this is your third asset class. Then all of us, whether we are aware of it consciously or not, have a leveraged investment in real estate because it's one of our biggest investment. Most of us take a loan to do it. And because we are taking a loan, we are automatically disciplined. We are giving an EMI, right? So that's your fourth asset class, which usually people don't escape unless they are renting. And the fifth asset class could be something that's less correlated with everything else in the market. So it could be gold, for example. So you can invest in sovereign gold bonds. So it gives you diversification. And it also acts like an insurance. So if your equities are going down, probably gold will not go down as much, or it would recover at some point of time where equity might still be lagging.
So in COVID times also, like it was considered as a safe haven and people were drifting towards gold.
Right. So gold is a bit interesting in the sense that it is a safe haven. It used to have characteristics of a pure safe haven when it was not financialized. In the sense when you had physical gold, of course, it was not moving with market. But as it has become more financialized, which means you have now ETFs and gold futures, it has also started being correlated to these risky assets. And the reason is simple. Let's say I am an institutional investor and I am leveraged, right? Leverage meaning that taken some debt and invested, right? That's what leverage is. So in case there's a sharp drawdown like the COVID pandemic drawdown, my leverage position will unravel, right? I will now have to liquidate my positions. If I hold stocks without leverage, I can write it out. Right? My stock goes down, I don't have to sell it. For an institution, there are two problems. One could be leverage, the other could be that because stocks are going down, people want to sell their funds. Right? So they have redemption requests. They may not want to sell the stock when it is 30% down, but they have so many redemption requests that they have to do it. Right? So these two pressures can make them sell out other parts of their portfolios, which although are safe havens, but because they have to meet this redemption request, they need some cash at hand. So they will sell whatever they can sell, right? So at that time, they will start selling things which have not drawn down as significantly as equities. So they will start selling bonds. So you will find that occasionally there will be a positive correlation between stocks and bonds, which is rare, but can happen. Similarly, they will start selling gold. So wherever you get a bid, right, wherever there's a market left, right, you start selling that. And then you see that everything starts going down at the same time. But that being said, gold, the primary driver is actually real interest rates. Now, equities also get affected by real interest rate, but not in the same way, not as directly. So as soon as in the pandemic, as soon as the central banks dropped down their interest rates, real interest rates actually went negative, gold shot up. Equities took their time to recover. So gold can still have this diversifier function. Gold is also having very different fundamentals from, let's say, an HUL stock, right? So you do not expect both of them to be very tightly correlated anyways, right? Apart from this portfolio effect. So you have these asset classes. So this is your big decision. But within the asset classes also, you need to be diversified. So rather than calling it an asset allocation decision, you should call it a diversification decision. And you should be diversified. And one thing that you should do is you should keep rebalancing, not very frequently, but let's say annually. So let's say I have just two asset classes, let's say, for illustration. I have stocks and bonds, 60% in stocks and 40% in bonds. Now some time has passed and equities have done really well and bonds have not done really well. Right? So now my allocation would have changed. Let's say 2 years have passed. And the reason why I'm saying 2 years is it will now be tax efficient to sell equities. So let's assume some sufficient time has passed. So now my allocation looks like 70% equity and 30% bond. I did not do anything. The reason why it looks like this is bond have gone down slightly and equity has gone up slightly.
That's true.
Now, if it is tax efficient to do it, you should rebalance to your desired portfolio. By doing that, what you're doing is, and this is something which is very interesting in investor behavior. It's an oddity actually. So actually what you're doing is, you're selling some equities and buying some bonds to rebalance. And what you're doing is you're selling something that is now relatively overvalued and buying something that is relatively cheap. Right? Yeah. So kind of behaving automatically like a value investor. This is what you should naturally do. I mean, you don't, and notice here, you don't have to predict anything. It has already happened. You are reacting to it. As I said, it is very difficult to predict anything happening. Yes. As I stand here today, I do not know what equities are going to do. But once after a year they have performed, then I can take an action according to it. So it's easier to react. Now, the reason why I say it is peculiar is because normally we are, especially Indians, we are very astute in finding the best deals. We are very value conscious, right? So all corporates who will come here, let's say in automobiles, right? They know Indian customers are value conscious. They will try to give as many features as possible, but the price should not go above 10 lakhs. Right? Yeah. Nobody will buy it. No, it's right. I have to buy a new phone. I will wait 6 months for the big billion sale and then I will buy the phone. But with stocks, we do exact opposite. So when stocks are going up, right? Yeah. Everything else being whatever it is, right? It is a fact that your expected return is going down. Yeah. Your long-term expected return is going down. So stock is really a claim on all the cash flows that this particular asset will give you. Now you can buy it for 100 today or you can buy it for 110 tomorrow. Even if you don't know those cash flows, you know for fact that if you buy it for 100 today, the return that you will get that you don't know is going to be more than the return that you get if you buy it for 110 tomorrow, right? So as stocks go high and high in the price, your expected return, whatever that may be, you do not know that for sure. You know that in bonds, but you do not know that in stocks. But it is going down. But when there is a ramping, there's a bull market, right? Everybody is bullish. All people on CNBCs are talking about structured bull stories, talking about 5 trillion economy, GST collection, right? Everybody wants to buy stocks at that time. And the reverse is also true. When stocks are collapsing, now it's rather unfortunate that nobody has really seen a protracted bear market, so people cannot relate to it. So 2020 was a two-day bear market, right? So that was not typical of a bear market in stocks. Typically, bear market are prolonged time corrections also, apart from price correction. So what we are now witnessing is somewhat a typical bear market. So it takes its time, grinds down, and then you have some sharp sell-offs, then you have capitulation. This is the time when you should be buying stocks. Nobody on TV will be telling you to buy stocks at that time because things would look very, very uncertain. This is the thing. The next bull market starts right at the bottom, right? When the thing are at its gloomiest, right? In fact, the very next day, when things are still horrible, maybe Deutsche Bank has just blown up, right? But the very next day, maybe is the start of the bull market. So that is the point at which you should be investing the most. But investors and financial experts who are really blindsided by all the negative news that is coming, and there's a lot of uncertainty because you do not know what is going to happen next, right? So at that particular time, you will find that nobody really wants to buy when the time is there to buy, when the stocks are on sale. So it's a reverse behavior that we follow in stocks. Now, people who do not day-to-day monitor markets will actually escape it by ignorance. If you do just sip every month and you forget about it, right? So you don't get into this behavioral trap. But those who are a bit more informed, a bit more savvy about financial markets, those who follow what Fed is doing, those who follow what is happening to Credit Suisse, are more likely to be victims of this bias. This is something that we should not do at all, right? So don't try to time markets. In fact, if you want to time, I would not call it time, I would call it reacting again. If stocks have fallen for whatever reason, buy a diversified portfolio of stocks. That is the best time to buy stocks. No matter what anyone says, stocks are corrected for 10%, 20%. There could be very bad reasons for that. And it is possible that stocks may correct further 30% also. Don't bother about it. The reason why I'm saying it is still your asset allocation decision. The reverse is happening. You had 60-40 portfolio. Now stocks have fallen down. Stocks are just 50% of your portfolio. Right? Bring it back to 60. Right? So don't look at valuations. Don't look at what is happening in the market. The reason why your allocation is now misaligned is because there is one asset class which is cheaper, right? And maybe bonds have gone up. Bonds will go up. Why? Because interest rates will go down, right? So sell some bonds, buy some stocks, right? So don't worry about what is going to happen. Don't try to predict everything, right? So react to things happening rather than anticipating or following people who claim that they can anticipate. Right. So this is something that you should follow in your personal finance. You should make goals. So goals should be big goals like retirements, wedding of a child, and for each goal, ideally you should have a separate pool of investment, right? And keep tracking that also. It will also not have a linear journey, right? So if you think you are deviating from your goal, try to push a little bit extra, right? So maybe tighten your purse a bit. Okay, I'm falling short on this goal number 1. So let me add a bit more capital to it. So that's how you stay disciplined. Don't have to know any rocket science in investing, and you can meet most of your goals. A simple example could be that I think I'm taking a lot of time on the first question.
We would love to have multiple series of podcasts on just personal finance.
Okay, sure. So I would not like that. but anyway, so a simple example could be that let's say your investment just meets inflation. Okay. Now you do not know what inflation is going to be in the next 30 years, but let's say it's going to be X, right? And wherever you invest, equities and bonds, let's say, collectively it gives you exactly X.
Yes.
Right. In that case, you know that if you are saving 50,000 per month in your pension account, right? Some of you may have NPS or EPF, or some of you may be saving it in a pension fund, right? So let's say your pension fund gives you exactly X% CAGR, right? Which is exactly equal to inflation. Then this pension fund is actually giving you 50,000 per month after your retirement, right? You're inflation protected. So is that going to be enough? So you have a fair sense of what 50,000 gets you today. You will have the same purchasing power at your retirement, right? So your expenses will also go down as you retire. You will have some assets already. So you maybe are not giving EMIs for your car and EMIs for your house then, right? So then you have 50,000 and you don't have to spend on your kid. You don't have to spend on a whole lot of things. So will 50,000 be enough? If you think it will be enough, then you are saving right amount for that goal, right? So that's an easy rule of thumb. And the final part is have some contingency, some amount that you have for contingency. So this could be, again, a rule of thumb could be 3 to 6 months of your income. Right? Now, this could be towards 6 or towards 9 months if you have a lot of dependents, or if you have a lot of fixed commitments like mortgages or EMI for your car, right? So if you have a lot of fixed commitments, a lot of dependents, then be more conservative, maybe have 9 months of income in a pool. And that doesn't mean cash under the mattresses. You can have it as a liquid fund, right? All other capital is in some way or other risk capital. Now, there's still a spectrum. It's not like you have cash and then you have all risk. So you can invest in bonds, for example. They are still very liquid. You are unlikely to lose money on them, but there's still some interest rate risk, right? So you can buy 10-year bond funds. You can buy 10-year bonds from RBI Retail Direct, but if you don't want to get into that, you can buy gilt funds. So SBI Magnum is a gilt fund. You can buy that fund. And that gives you reasonable returns with almost no risk. And if you invest for 2-3 years, it's almost impossible to get a negative return there, right? But theoretically, it's possible. So that's one part away from cash. Then you can go to corporate bonds, then you can go to safer equities, then you can go to riskier equities, right? So you have this whole spectrum of risk, right? So all of it is your risk capital. And when I say risk capital, basically it means that there may be a time where you do not want to liquidate it, right? So you have your contingency fund separate. Whenever you have contingency, you tap into that fund. That's your liquid fund. But you do not want to be forced to liquidate this capital, right? Because that is likely to happen at exactly the wrong time. So portion your capital or investment in this way. That contingency fund would be sufficient. And also a big contingency could be your medical expenses. So for your family, have a medical cover. So have a term insurance, a general health insurance, and have a critical illness insurance. So once you are done, you have covered more or less all bases, right? Without thinking about what a particular stock is going to do, right? And that's how I think a typical investor should invest. You do not need to devote a lot of time. You can annually look out at your portfolio and rebalance, and ideally do it in a way that minimizes your taxes. That's all there is.
Absolute gold advice for all the personal finance enthusiasts or someone willing to just get into investing. I mean, we can go along for hours on this. I'm pretty sure that you could talk about retail direct and everything, but maybe we should shift our tangent to some different topics today. And let's talk about the viewpoint of MBA students, especially the ones who are not from a core finance background, but are finance enthusiasts. Do you think that what learning path they should follow? I mean, does certifications like CFA, FRM, वगैरह help them during their MBA journey, or maybe they can tag something else along the way?
So I think it does help. I am an FRM. I did my FRM when I was in IIM Lucknow. I did FRM because it was cheaper and it was easier to get it than CFA. So because there were just 2 rounds. It's not, curriculum is not easier, but there's just 2 rounds to clear. For CFA charter, I think you need some experience also before you get a charter.
Charter holdership, you need roughly 3 years of
experience, right? So it's not something that you can get directly during your MBA. But that's, having said that, I think I've gone through the curriculum of CFA, actually working on an elective investments, which I want to closely align to CFA curriculum. And the reason for that is, first, it will help some of the students who are aspiring for CFA. And I like the curriculum. It is made by industry practitioners. So the thing is, there is this core theory, which is a product of decades of research, very, very elegant in terms of its economics, in terms of its analytical rigor. And if you look at the way it is formalized, it is fantastic. But the problem is, in reality, it doesn't work. So it requires certain inputs which in reality are noisy, and that small noise in those inputs will make it completely useless in practice. So if you look at practitioners, they would not be using these theories, and they would be mocking at people who talk about these theories, right? So if you look at CFA curriculum, it will talk about some of the, now I will call them heuristics because they are not theoretically perfect, but they tend to work in practice. That's why I'm calling it heuristics, but they are used in industry, right? So you get some exposure to that as you go through the CFA curriculum. So apart from giving you a CV point, bringing some finance flavor to your CV, it also is a good learning experience. So I think people who are interested in finance, MBA students, should almost certainly go for a CFA. FRM is somewhat more niche. If you're looking for risk management roles, then FRM is better than CFA because you get more in-depth understanding of risk modeling, credit risk, operational risk, a better understanding of modeling, expected shortfall, value at risk. So these are the core thrust areas there. CFA is more generalized. So it thinks that you will become a money manager in some capacity. So you think about fiduciary duties of a money manager, ethics of a money manager, also where you should invest. You will invest in 5 different sort of asset classes, mechanics of each of those asset classes. So in no real regard, it will go in as much detail as FRM curriculum goes into risk management. Right? So depending on what career path you want to choose, I would strongly recommend that you should go for CFA or FRM, depending on whatever is
someone wants that will be into risk management, so interested, then they can go for FRM. Thank you so much. So it's high time that we address the real sensation right now. And we all have heard of ChatGPT, and in fact, MBA students must have got some idea and some experience along those lines. Well, what are your views on AI platforms like this impacting the finance world? Do you think it will cause a major shift in job profiles? And which roles be most impacted if it does?
So you were one of my students, so you know that I was also interested in ChatGPT. So when I was teaching corporate finance, this is when it was released. Version 3 and 3.5 were released at the time. So like every smart person that I knew at the time, everyone was trying to dabble with it. And it gives pretty remarkable results. One of the things that where it really excels at, I don't know whether you have tried it or not, but I actually got hooked when I asked it to code an option pricer in Python. And it did it in 2 minutes and gave me a working code. Now, I could not do it because I'm not very well versed with Python, but I executed it and it ran. So that was stunning to me, that I can give just as one line prompt and it can create a code. Now, if you talk specifically from finance, first of all, for those of you who do not know what ChatGPT is, it's basically a AI chatbot, right? So it's a language model which can understand what you're saying in natural language. So you don't have to give a SQL query. You can say anything. It will interpret it. It will try to add context to it also. So you can have a conversation. I ask you one thing, then I ask you another. It remembers the earlier question and tries to contextualize the next response based on it. So it looks much like you're talking to a human, right? So that's what ChatGPT does, and it does it very well. So it's a refined technology, and if you think about it, the obvious applications are in fintech, for example, being customer support. Right? So customers, instead of talking to an advisor, can have their unstructured query asked to a AI chatbot, who is now specializing in finance-related questions. So you actually have to train this model. So you can train it into a particular domain also. And you can say that I'm 30-year-old and I have a goal that when I retire at 60 years, I should have this much in my bank account. So where should I invest? Like you can ask an advisor and it will give you very specific guidelines. In fact, it can do much more. So for example, just yesterday I saw a tweet in which some person said that he had a dog and the dog was critically ill. And he went to a vet, they ran some tests, so vet suggested some treatment, and the dog went worse in its condition. So what he did was, he actually transcribed everything in the results and fed it to ChatGPT and asked it to diagnose. And ChatGPT, after putting the usual disclaimers, I am not a vet and I don't know, etc., actually gave 3 possible diagnoses. And one of the diagnoses was correct. All of this sounds amazing, right? And I was also amazed initially. So for fintech, for example, you can have this advisor, automated advisor, doesn't sleep 24/7, he's on. You can also make personalized advisors. So for example, one of the reasons why people go to these financial advisors is trust, right? So they know their history, they know what has happened, maybe I'm risk averse, maybe I'm not, maybe something bad happened to my investments. And I have this personal instance of chat GPT for this particular person who knows everything about the history, much like medical records or whatever, right? So you have your financial transaction records, and he knows that whether you are risk averse, whether you get emotionally triggered if you have a drawdown, right? And gives you advice based on that. So that can build a bit of trust also, right? In an automated fashion. But the problem that I see, so before I go to the problem, let me tell you other things that it can do. So for example, robo-advising. Robo-advising is something which is already done by AI, but it can be done in a much more efficient way by ChatGPT because it can understand natural language.
Yeah.
So for example, there's this company called Stripe. You have heard of it?
No, sir.
Okay, Stripe is a payment system. It has integrated GPT-4 in its platform.
Okay.
So they use it for n number of things. So they use it for all of these things like customer support, etc. But their developers, when they are looking to find a specific piece of documentation, right? Instead of going through that 500-page manual, they can just ask ChatGPT, I am looking to do this. How should I do this? It will go through all the documentation and will give you a human readable. Just like asking you, right? You are an experienced programmer and I asked you, I am stuck at this. What should I do? And ChatGPT will tell you, okay, this is the function that you have to use. And it's a big time saver. But they also use it to detect fraud. So what they say is that ChatGPT can understand the nature of customer communications and transactions. And based on that can also red flag possible customers who are not behaving properly, right? So they are using it to detect fraud, right? There's this Chinese gaming company, I'm forgetting the name, I think it's called NetDragons or something. So they actually had it was not ChatGPT, they had a CEO who was an AI, and it ran the company. And it was a big news because during the period in which it ran the company, the returns of the company were higher than Hong Kong index, right? And
over a longer duration.
Over a reasonable long duration, right? And it was not some mechanical thing that was the target of this AI. It was given very broad goals. So you have to take leadership decisions. You have to make workplace effective for employees, right? So very, very broad things that you would expect a CEO to do, and analyze data and take business decisions, which you would expect an AI to do probably. That AI ran for a while. It's not a small company, reasonably big. There are a lot of games that are very popular.
Yes.
And I've come to realize this. It is very good at giving you answers that look polished. But if you are an expert in that field, then you will quickly realize that what ChatGPT is giving you is at best very, very average or low-level output.
In a sophisticated manner.
Not even in a sophisticated manner, in a manner which appears human-like, right? So someone who knows about this thing is telling you. So for example, I asked it to write an option pricer in Python. Not very familiar with Python. I see that it is generating codes in seconds. It runs, it does what it is asked. So I get impressed, right?
Yeah.
But I showed that code to one of my friends who is still in tech, and didn't tell him that it is generated by GPT. And he pointed out whole lot of bugs in that. So this will break, this validation is not done, this is inefficient, okay, it's not clean, this object, right? So at best, it was a mid kind of a programmer. I then tried to experiment a bit more. So I have a sister who is doing PhD in literature. Right, so I know nothing about literature, but I asked him to give this thing a prompt. So she asked for an imagist poem, write an imagist poem in style of a particular author. I forget the name, right? So it immediately came up with a poem. In fact, I also did the same thing, if you remember, during a course. Yeah, so I asked it to write a rap song.
Yeah.
Right, so I'm not a rapper, so I was impressed.
We all were.
But the thing is, this poem was very nice sounding, and it was generated in 30 seconds. But my sister told me that it looks like the author is copied, but the poem itself is not imagist. So imagist is something that actually describes an idea or a concept in a way that makes you visualize an image, right? Something like that. That's, I don't know for sure what it is, but she explained it in a way that he said, this is not correct. Right, this is not correct. So then I thought that I understand finance. So let me try to grill it on finance. Right. So I actually gave all the questions that I gave for CF1 to this particular AI student, and I'm happy to announce that it scored D. So you guys are safe. So I think there's a long way to go. Where it excels is in disguising itself as very human-like. But if you look at the quality of output that it produces, so one of the things that it cannot do, and I try to do it because this is what we have to do, is write a research paper. ChatGPT, first of all, cannot write very long monologues. So it cannot write 30-page papers. Now, why cannot it write 30-page papers? The reason why it cannot write 30-page papers, I came to realize, is it cannot hold a narrative. So when you write a big piece, big article, not a research paper, let's say an article in Economist, right? So you talk about a particular theme, okay, and then you build a narrative. And every particular section in your article actually comes down to that particular narrative in different directions, right? ChatGPT cannot do that, right? So you can write 4 paragraphs which seem to be on a topic. You cannot ask it to maintain a narrative. So any article that is produced by ChatGPT, if I give you 10 Economist articles and I disguise one of the ChatGPT articles as an Economist article, right? Even if you do not know anything about economics or finance, you would say this is the worst article Economist has ever written. So because there will be no flow. Right? Right? So there are major limitations. The second limitation is that ChatGPT cannot generate knowledge. It learns.
From historical.
It learns. And first, learning itself is problematic because it learns from how you train it. So if your training set is biased, so it's unsupervised learning, right? So you give it a corpus of documents. Now, if I give it a lot of documents that confirm that Earth is flat, right? And maybe 1 or 2 articles that dismiss it and thousands that confirm it, it will be biased towards claiming that Earth is flat. Right? So that may seem like an absurd example, but any development in knowledge actually comes from refuting what is currently accepted. So what is currently accepted, what is currently mainstream, if it has to be refuted, if you have all of these AI assistants telling 99% of the people say this is wrong, right? Then new knowledge, I don't know how it will get. So if you rely on them for inputs, I don't know how it will interact with new knowledge creation. It cannot create new knowledge on its own. When COVID struck, in a matter of days, the virus genome was sequenced. New vaccine candidates were starting trials before the market fell, actually. So in February, some company, I think in Israel, started trials. Now, ChatGPT cannot do it. It cannot take a new problem, create a solution. They didn't just run trials. They actually interpreted those results. There were double-blind tests, right? And then there were third-party verifications of those tests, right? So you cannot expect ChatGPT to even conceptualize what to do to deal with a completely new situation. It can regurgitate very well what is already understood, but to create something new. And I think at some level, all of us will become some sort of creators now. And this is where we will probably always have an edge. I have no understanding of how AI is going to evolve. At least now we have this edge over ChatGPT. And you can think of any number of disciplines in which you can verify it. You, for example, are interested in algo trading.
Yes.
Right? So ask it prompts about algo trading and you will see how mediocre the responses are. Right? Now, ChatGPT 4 is technologically superior. It can also understand images. Right? So it can interpret images, let's say your medical reports, or maybe you have an Amazon order for which you have an invoice. You send it to ChatGPT 4, it can understand what it is. But that's much like an image search function which has been added to it. It's good, but it doesn't resolve the fundamental problems that I think at a very, very low level employment, where people who are working are not skillful, not articulate, cannot even draft a single email. Those kind of jobs can be easily replaced. So you maybe want to write a simple newsletter, which is not very abstract, which does not have any nuances, just as an informative kind of a thing that you want to email to all your customers. Rather than having an intern, you would rather have ChatGPT.
Write it out.
But beyond that, in any domain, I think there's a fair way to go before
Still a long way.
before we can substitute people with ChatGPT.
The people who are going to take investments in fourth semester, I'm pretty sure that after watching this podcast, they will be aware about assignments given in those terms, especially around ChatGPT. Okay, so that's a thought-provoking perspective. As we wrap up our discussion, where can our listeners connect with you? Any social media platform you are active or?
I am available on Twitter. My handle is Prof Prateek, PROFPRATEEK.
Professor Prateek.
And that's all I use basically on social media. And not very active in terms of posting there, but if you want to connect with me, you can just send me a DM. So I check it daily.
Thank you, Professor, for joining with us today and sharing all those valuable insights. It has been an honor to host you.
It was a pleasure.
Thank you so much.
Thank you.